picture this. You are staring at your bank account, and there it is, $1,000.
A great feeling.
Right.
Yeah.
I mean, you worked hard for it. You finally managed to save it up, and it's just sitting there staring right back at you. But instead of feeling victorious, you feel this sudden paralyzing wave of anxiety.
Oh, absolutely.
You just freeze up. You're terrified of making the wrong moves. But here is the statistical truth leaving, that money in your standard checking account for the next 10 years is literally the only guaranteed way to ensure you lose wealth.
Because of inflation.
Exactly. Thanks to the silent thief of inflation.
It is a completely universal experience, and honestly, that paralysis is totally justified. I mean, the financial world goes out of its way to make investing look like this highly exclusive club, for sure. Like, it only happens in glass boardrooms with guys in $1,000 suits executing these complex trades on 6 different monitors. They want you to believe it is way too complicated to handle on your own.
Yeah, it feels like if you don't know the secret handshake, you are going to lose everything. But that is exactly the illusion we are dismantling today.
Love that.
Our mission for this deep dive is to demystify the foundation of wealth. We are pulling from an incredibly practical, jargon-free 2026 YouTube guide by a creator named Nick Invests.
It's a fantastic resource.
It really is. The goal is to give you a snappy step-by-step roadmap to investing that very first $1,000. No Wall Street mumbo-jumbo, no day trading, and definitely no crypto schemes promising you a private jet by Tuesday.
Okay, let's unpack this, because making the choice to start actually matters a lot more than the dollar amount itself, doesn't it?
It matters fundamentally. I mean, people delay investing all the time because they think $1,000 isn't enough to bother with.
Right, they think they need 50 grand just to open the door.
Exactly. They assume they need massive capital. But making the right move with this specific initial $1,000 very often leads to far more long-term wealth than someone who, later blindly throws 10 grand at some trending stock on social media, because you're building a habit.
You are setting up the machinery for your financial future. Once the machine is built, the amount you feed into it simply becomes a matter of scale.
I love that, the idea of building a machine.
Oh.
But before we can turn that machine on, before we send that $1,000 out into the wild to multiply, we actually have to protect it. Which brings us to the very first step of the source material.
The crucial first step.
And I have to admit, I'm going to push back a little here. Wait, so you're telling me the very first step of investing our $1,000 is to, well, not invest it?
Yes, exactly.
It feels a bit like being told you have to eat a giant bowl of boiled vegetables before you're even allowed to look at the dessert menu.
Look, eating your vegetables is the only way to ensure you are actually around to enjoy the dessert.
Fair point.
Think of it like a house. You cannot build a house without pouring a solid concrete foundation first. If you skip the foundation, the framing might look beautiful for a month or two, but the second a storm rolls in, the whole structure just collapses.
So true.
In financial terms, this means establishing a basic emergency fund before you even consider opening a brokerage app. You need at least 1 month of basic living expenses sitting in a highly accessible, high-yield savings account.
Okay, let's break down the mechanics there. So if my rent, my groceries, and bare-bones bills cost $2,000 a month, I need $2,000 saved. But what makes a high-yield savings account, or HYSA, very different from the checking account I've had at my local bank since high school?
Traditional brick-and-mortar banks have massive overhead. I mean, they have marble lobbies, thousands of tellers, physical vaults. All of that costs money.
Right, the free lollipops aren't actually free.
Exactly. To pay for all that, they give you an interest rate of basically zero, maybe 0.01% on your savings. High-yield savings accounts, on the other hand, are typically offered by online-only banks.
So no branches.
None. Because they don't have to pay for physical real estate, their overhead is microscopic.
Yeah.
So they pass those savings directly to you in the form of a much higher interest rate. We're talking 40 or 50 times higher than a traditional bank, all while keeping your money completely safe and insured.
That makes perfect sense. So we put our 1 month of expenses into that online account. Let's explain why this buffer is so crucial to the investing process itself.
It's the ultimate defense mechanism.
Right. Let's imagine I skip this step. I take my hard-earned $1,000 and I put it straight into the stock market. I'm feeling like a Wall Street genius. But 3 months later, my car breaks down and the mechanic hands me a bill for $800. If I don't have that cash buffer, what actually happens?
You are forced to cannibalize your own wealth.
Oof.
You have to log into your brokerage account and sell your investments just to pay for the car repair. And the cruel irony of the universe dictates that the stock market will inevitably be down the exact week your transmission blows.
Oh, 100%. It always happens that way.
Right. So you are forced to sell your investments at a loss. You pay the mechanic, you lose money on the stock trade, and you walk away feeling entirely defeated. You end up swearing that the stock market is just rigged against you.
When really it's just a lack of preparation.
Exactly. The emergency fund acts as a moat around your castle. It prevents the forced sale of your assets when life inevitably happens.
It's a defense mechanism. Okay, so that's the first unsexy prerequisite. The second one is the elephant in the room debt. Specifically, high-interest credit card debt.
What's fascinating here is the pure, undeniable mathematics of consumer debt versus market returns. People naturally want to jump straight to the exciting part of building wealth, right?
Yeah, everybody wants the fun part.
But in their rush, they ignore the gaping hole in the bottom of their financial bucket.
Let's run the numbers on that leaky bucket. Historically, the stock market returns an average of about 10% per year over the long run.
A solid return.
Right. But if you were carrying a balance on a credit card, the bank might be charging you 20% or even 25% in interest.
And that is exactly the problem. Mechanically, if you invest $1,000 while holding $1,000 in credit card debt, you are effectively borrowing money at a guaranteed 25% penalty.
Just to gamble on earning a 10% reward.
Yes. Let's visualize that. Your investment makes you $100 over the year, but your credit card company charges you $250.
Ouch.
You feel like an investor, but you are actually bleeding $150 a year. It is a mathematical impossibility to build wealth that way. Paying off that high-interest debt is effectively a guaranteed, risk-free 25% return on your money.
Now, to be incredibly clear on the nuance laid out in the Nick Invest Guide, we aren't saying you have to be completely 100% debt-free across your entire life to start investing.
Right. Not all debt is an emergency.
Exactly. The rule of thumb the guide lays out is the 15% rule. If the interest rate on your debt is above 15%, you stop everything and pay that off first.
Priority number one.
But if you have low interest debt, like a 4% mortgage or maybe a 6% car loan, you are totally fine to keep paying the minimums on those while investing your $1,000.
Because the logic remains mathematical. If your car loan costs you 6% and the market historically returns 10%, your money is working harder for you in the market than it would be paying off the car.
It makes sense.
It's all about directing your dollars to whichever arena offers the most heavy lifting.
Okay, so the foundation is poured, vegetables have been eaten, we have our emergency fund, and any toxic high-interest debt is cleared out. Now, we finally have our $1,000 ready to deploy.
The fun part begins.
Yes. The next logical question is, where does it physically go? What kind of account do we put it in? Here's where it gets really interesting. Picking the account is like choosing whether to grow your crops in an open field or a government-approved greenhouse.
Oh, I like this analogy.
Right. If you grow them in the open field, which is a standard taxable account, the taxman comes by every single season to take a cut of your harvest. But if you plant in the Roth IRA greenhouse, the door locks behind you.
And the taxman stays outside.
Exactly. The taxman isn't allowed inside, and you get to keep every single tomato you grow.
That is a brilliant way to conceptualize it. The account type is simply a wealth shield. It dictates how much of your profit you actually get to keep versus how much you surrender to the government. And for a beginner, the undisputed star of the show is the Roth IRA.
I love talking about the Roth IRA because it legitimately feels like a cheat code. Like, it shouldn't be legal.
It really does.
With a Roth, you take money that has already been taxed, like the money from your paycheck that clears into your bank account, and you put it inside the greenhouse. Here's the magic trick. Every single dollar of growth inside that account is completely 100% tax-free when you pull it out in retirement.
It cannot be overstated how powerful that compound growth becomes when it isn't being dragged down by taxes year after year.
The numbers get crazy.
They do. The guide provides a staggering example. If you invest your $1,000 today, and over the next 30 years it grows to $50,000, you have generated $49,000 in pure profit.
Okay.
When you withdraw that money in retirement, you pay absolute zero on that $49,000 of growth.
Zero. Zip. Nada. It's wild. But naturally, because it's such an overwhelming advantage, the government puts restrictions on it.
Right. There are rules.
According to the 2026 limits, if you're under 50, you can only put in $7,500 a year. If you're over 50, you can put in $8,600. And the other massive catch is the age lock.
The trade-off.
Yeah, you generally cannot touch the growth of that money until you are 59 and a half years old without facing some pretty stiff penalties.
Because it is a vehicle designed specifically for long-term wealth building, the government basically incentivizes you to lock it away so you don't become a financial burden on the state in your old age.
Let me push back on that, though. I'm looking at my $1,000 right now. Maybe I want to buy a house in 5 years, or maybe I want to start a business. Locking my money away for decades sounds honestly suffocating.
A lot of people feel that way.
What if I need access to it?
That is a vital distinction to make. With a Roth IRA, you can actually withdraw the original contributions you put in at any time, penalty-free.
Oh, really?
Yes. It is only the growth that is locked behind the age barrier. However, if your primary goal is to use this money in the near future, you probably need to step out of the greenhouse and use the second option, the taxable brokerage account.
Let's explore the open field then. How does a taxable account work?
Total flexibility. There are no contribution limits, no income caps, and absolutely no age locks. You can deposit $1 million tomorrow and withdraw it next Thursday.
But there's a catch.
The trade-off is right there in the title. It's taxable. When your investments generate a profit, you owe the government a cut.
But the mechanism of that tax matters.
Right.
If you buy a stock, hold it for a few weeks, and sell it for a profit, you pay short-term capital gains, which is taxed basically like your normal salary.
Right.
But if you hold the investments for more than a year, you pay long-term capital gains tax.
Precisely. And long-term capital gains rates are significantly lower than standard income tax rates. It is essentially the government rewarding you for holding assets rather than day trading.
Okay, I see.
So the decision matrix becomes very straightforward. If you do not need this money for at least 5 years, the Roth IRA is undeniably your strongest shield. But if you have a shorter timeline, the taxable brokerage is the necessary path.
Okay, we've got the foundation. We've picked our Roth IRA greenhouse. Now comes the moment of truth. We have to actually press buy.
The first part.
And naturally, this is where my brain starts getting greedy. If I want to get truly wealthy, shouldn't I try to find the absolute best, most innovative company in the world? Like the next Apple or the next revolutionary AI startup and just bet my whole $1,000 on them? Why are we diluting our money by buying a bunch of different things?
It is the most intuitive question a beginner can ask. Society conditions us to believe that outsized results require highly concentrated, brilliant bets.
Exactly.
We watch movies about rogue traders making billions on a single hunch. But the mathematical reality of the stock market operates on entirely different principles. Before we explain the mechanism of what to buy, we have to emphatically state what not to do.
Oh, the source material did not mince words here.
No, it did not.
Do not buy whatever obscure penny stock your cousin's friend pitched at a backyard barbecue. Do not buy whatever volatile tech company is trending on social media from an anonymous user named DiamondHands420. And please, whatever you do, do not start day trading.
Attempting to day trade with your first $1,000 is statistically indistinguishable from taking your rent money, flying to Vegas, and putting it all on red at the roulette table.
Just totally gambling.
Exactly. You might get lucky on the first spin. You might even get lucky on the second. But eventually, the probability catches up with you. You will find yourself eating ramen noodles, staring at a zero balance, and trying to explain to your landlord why you are short on rent.
So if we aren't hunting for the next Apple before anyone else finds it, what is the actual game plan? The guide calls it the boring win. It all centers around a concept called the three-fund portfolio.
It sounds like intimidating financial jargon, but the three-fund portfolio is really just a highly efficient way of saying do not put all your eggs in one basket.
Keep it simple.
Yes, it is the precise strategy that has quietly manufactured more millionaires than almost any other approach. Instead of buying individual stocks, you divide your money into 3 massive buckets, which are known as index funds.
Let's break down the mechanics of those buckets and the specific percentages the guide suggests. First, you take 60 to 70% of your $1,000 and put it into a total U.S. stock market index fund, or an S&P 500 fund.
The core of the portfolio.
Right. Instead of trying to guess which individual American company will dominate the next decade, you are buying a microscopic slice of the entire American economy. The guide mentions a few specific funds you can look up to do this, like VTSX from Vanguard, FXAIX from Fidelity, or SWTSX from Schwab.
Just paint the picture of what owning that fund actually means.
Okay.
Every time someone upgrades their iPhone, you make a fraction of a penny. Every time someone orders a package on Amazon, you profit. Every time a business pays for Microsoft software, a microscopic dividend flows back to your account.
That's incredible to think about.
You transition from being merely a consumer to being a partial owner of the infrastructure of the modern world. Furthermore, an index fund is self-cleansing. If a company goes bankrupt, it just falls out of the index, and a new, thriving company replaces it automatically.
You literally own the system. Okay, the second bucket takes the next 20 to 30% of your money and puts it into international index funds. Funds like VTIX, FTIHX, or SWIISX.
Right.
But my instinct is to ask, if American companies are doing so incredibly well, why bother sending my dollars overseas?
It comes down to mitigating structural risk. You are diversifying geographically. There will be years or even entire decades where international markets significantly outperform the U.S. market.
So you're hedging your bets.
By owning both, you guarantee that you are positioned to capture the growth no matter which region of the globe is surging. More importantly, it protects you from being completely reliant on the political stability, economic policy, or consumer habits of a single nation.
Total global coverage. You own the world. Then the guide leaves a tiny sliver, 0 to 10% for bonds. Just to be extra conservative. Let's clarify what a bond actually is, because it gets thrown around a lot without much explanation.
Think of a stock as owning a piece of a company. You share in the profits, but you also share in the losses.
Right.
A bond, on the other hand, is you acting as the bank. You are loaning your money to a corporation or to the government, and they are legally obligated to pay you back with a set amount of interest over a specific time frame.
It's much safer.
It's a contractual guarantee. Because the return is guaranteed, the profit is lower, but it acts as a shock absorber for your portfolio when the stock market gets bumpy.
Though the guide notes that if you are young and just starting with your first $1,000, you probably don't even need that bond shock absorber yet. You want that money working as aggressively as possible in the stock funds.
Usually, yes.
So we are buying these massive index funds. This brings up the great active versus passive debate. The strategy we just outlined, buying index funds and literally doing nothing, is passive investing.
And here is the secret Wall Street praise you never figure out.
What's that?
This incredibly simple, remarkably boring strategy consistently beats about 90% of professional money managers over the long term.
Which completely defies logic until you look at the mechanism of fees, right?
Exactly.
These active managers are brilliant people in $1,000 suits with Ivy League degrees working 80 hours a week to outsmart the market. But they charge you for that effort. When you buy a passive index fund, you are paying a management fee of usually less than 0.1%.
It is virtually free.
Yeah. But active fund managers charge 2 or 3% every single year, regardless of whether they make you money or lose it.
Plus, because those active managers are constantly buying and selling stocks trying to time the market, they trigger transaction costs and tax events that bleed the account dry.
The source material has a brilliant analogy for this friction. Imagine you are trying to fly across the country.
Oh, this is a great one.
Active trading is like hiring a travel agent who books you a flight with 5 different layovers because they swear it's a smarter route, but they charge you a massive premium for their expertise, and half the time you miss your connection anyway.
Sounds miserable.
Passive index funds are just booking the direct flight. It's a fraction of the cost, infinitely less stressful, and you almost always arrive at your destination sooner. Friction destroys wealth. Simplicity preserves it.
So true.
So what does this all mean? We've got the foundation. We've chosen our Roth IRA greenhouse. We've bought our globally diversified index funds. Our direct flight is booked. The $1,000 is officially invested.
Mission accomplished.
But let's be realistic. $1,000 by itself, even compounding at 10% a year, isn't going to buy anyone a private island anytime soon. How does this initial $1,000 actually transform into life-changing wealth?
It turns into life-changing wealth by removing the human element entirely. The true value of this first $1,000 isn't the monetary amount. The value is that it forces you to build the infrastructure.
Right.
Once the infrastructure is built, you introduce the final step, dollar cost averaging.
It's like a subscription service for your future self. We automate our streaming services. We automate our gym memberships. Even the months we don't go, why wouldn't we automate our actual wealth?
Precisely. You set up a system where your brokerage account automatically pulls a set amount from your checking account every single month, say $200 a month.
Just runs in the background.
You set the rules once, the money transfers automatically, buys the index funds automatically, and you never have to intervene.
Wait, I'm stuck on this automation idea. Let me play devil's advocate for a second.
Go for it.
If I turn on the TV and the financial news is screaming that the market is crashing and a recession is looming, wouldn't I be an absolute idiot to let my account automatically buy more? Why wouldn't I just hit pause on the automation until the economy looks safe again?
If we connect this to the bigger picture, hitting pause is exactly how average investors destroy their own returns.
Royally.
Yes, human beings are deeply emotional creatures. We are biologically wired to run away from danger. When the market is crashing, your instinct is to hoard cash. When the market is booming, your instinct is to buy in because of FOMO, fear of missing out.
Right, you want to jump on the bandwagon.
And you end up buying when prices are at their highest and selling when prices are at their lowest.
The exact opposite of what you were supposed to do.
Exactly. Automation entirely removes your flawed psychology from the equation. Let's look at the mathematical mechanism of dollar cost averaging. Let's say you automate $200 a month.
Okay.
Month 1, the market is normal. An index fund costs $100 a share, so your 200 buys 2 shares. Month 2, the market crashes violently. The shares drop to $50 each. Because you didn't hit pause, your automatic 200 now buys 4 shares.
Oh, wow. So you're automatically buying twice as much property simply because it went on sale.
Yes. You now own 6 shares for a total investment of $400. Your average cost per share drops to roughly $66. When the market inevitably recovers to just $80 a share, which is still lower than where it started, you are already highly profitable.
Yeah, that's amazing.
The automation forces you to buy heavily into the crashes without you ever having to summon the courage to log in and press the button. It naturally smooths out the volatility over decades.
It's the ultimate set-it-and-forget-it mechanism. Get to focus your energy on living your life, advancing your career, and spending time with your family while your financial machine just hums in the background, quietly buying up tiny pieces of the global economy month after month, crash after crash.
That is the real secret of the wealthy. They do not possess better crystal balls to predict the future. They simply build better systems that mathematically guarantee their participation in the growth of human progress.
I love that perspective. So to wrap up this journey, look, the reality is this first $1,000 is not going to change your life overnight. You aren't going to wake up tomorrow and dramatically hand in your resignation.
Not quite yet.
But what it represents is far more powerful. It is your declaration of financial independence. It is the moment you prove to yourself that you are capable of making smart, foundational money moves. It's the exact moment you decide you aren't destined to work until you are 70 just to afford cat food in retirement. You built the greenhouse, you planted the seed, and you turned on the automatic sprinklers.
Watching that seed grow inevitably changes how you view yourself and your capabilities. But it also raises an important question, something I think is worth reflecting on long after this deep dive ends.
How would I lay it on us?
We just established that automating our investments is the ultimate key to wealth precisely because it removes our flawed, highly emotional human decision-making. It takes our ego entirely out of the equation.
Right.
So what other areas of our lives, our careers, our relationships, our daily habits are we secretly sabotaging simply because our ego insists on remaining in control?
Oof. That is a heavy, fantastic thought to chew on. Automating out the ego to get out of our own way. Well, that is all the time we have for today's deep dive. We hope this roadmap helps you look at that $1,000 in your bank account, not with paralyzing anxiety, but with genuine excitement for the machine you are about to build. Keep exploring, stay curious, and we will catch you on the next one.